Welcome to our YouTube channel, where we empower you to take control of your financial future. Today, we're diving into the exciting world of investing. Whether you're a seasoned pro or just starting out, we'll walk you through the fundamentals of building wealth with stocks and bonds. So, let's get started. Investing can be an intimidating topic for many people, particularly those who are new to the world of financial planning. However, building wealth through investments is a critical step towards achieving financial freedom and stability. Stocks and bonds are two of the most popular and accessible investment opportunities available, yet many people do not understand how they work or how to get started. In this video, to investing in stocks and bonds, we will break down the basics of these investment vehicles and help you understand how to make informed decisions about your finances. We will cover everything from understanding the stock market and bond market, to evaluating risk and identifying potential returns. By the end of this guide, you will have a solid foundation in investing that will help you build long-term wealth and secure your financial future. Understanding the basics. What are stocks and bonds? Stocks, also known as equities, represent ownership in a company. When you buy a stock, you become a shareholder and have a claim on the company's assets and earnings. As the company grows and becomes more profitable, the value of your stock may increase, allowing you to sell it at a higher price and make a profit. However, stocks are also subject to market fluctuations and can be volatile in the short term. On the other hand, bonds are debt securities issued by governments, municipalities, or corporations. When you invest in a bond, you are essentially lending money to the issuer with the expectation of receiving regular interest payments and the principal amount back at maturity. Bonds are considered less risky than stocks because they offer a fixed income stream and have a predetermined repayment schedule. Both stocks and bonds have their own unique characteristics and benefits. Stocks offer the potential for higher returns but also come with higher risks. Bonds, on the other hand, provide stability and income but generally offer lower returns compared to stocks. It's important to note that diversification is key when building an investment portfolio. By investing in a mix of stocks and bonds, you can spread your risk and potentially maximize returns. Understanding the basics of stocks and bonds is the first step towards making informed investment decisions and embarking on your journey to building wealth. The benefits and risks of investing in stocks. One of the primary benefits of investing in stocks is the potential for high returns. Historically, stocks have outperformed other investment options such as bonds or savings accounts over the long term. This means that by investing in stocks, you have the potential to earn significant profits and grow your wealth. Furthermore, investing in stocks allows you to participate in the success of well-established and emerging companies. By carefully selecting stocks, you can invest in companies that align with your values and beliefs. This can be particularly appealing for those interested in supporting environmentally conscious or socially responsible businesses. However, it is essential to recognize that investing in stocks inherently involves risks. The stock market is subject to fluctuations and volatility, meaning that the value of your investments can go up or down. This volatility can be influenced by various factors, including economic conditions, industry trends, and company-specific news. Investors must also be prepared for the possibility of losing money in the stock market. While the potential for high returns exists, there is also the risk of losing a portion or even the entirety of your investment. It is crucial to approach stock investing with a long-term perspective, understanding that short-term market fluctuations are normal and should not deter you from your investment strategy. To mitigate risks associated with stock investing, it is advisable to diversify your portfolio. By investing in a variety of companies across different industries, you spread your risk and reduce the impact of any single stock's performance on your overall portfolio. In conclusion, investing in stocks offers the potential for significant returns and the opportunity to participate in the growth of companies. However, it is important to understand and manage the risks involved. By conducting thorough research, diversifying your portfolio, and adopting a long-term perspective, you can navigate the stock market and work towards building wealth over time. The benefits and risks of investing in bonds. Investing in bonds can be a valuable addition to any investment portfolio, providing both benefits and risks that investors should carefully consider. Bonds are essentially loans made to corporations, municipalities, or government entities in exchange for regular interest payments and the return of the principal amount at maturity. One of the key benefits of investing in bonds is the relative stability they offer compared to stocks. Bonds are generally considered lower risk because they have a predetermined interest rate and maturity date. This predictability can be especially appealing to conservative investors who prioritize capital preservation and a consistent income stream. Additionally, bonds can provide a steady stream of interest payments, which can be particularly attractive for retirees or those seeking a reliable income source. Another advantage of investing in bonds is their diversification potential. By including bonds in your investment portfolio, you can mitigate risk and balance out the volatility associated with stocks. Bonds often have a low correlation with other asset classes, such as equities, which means they may behave differently in response to market fluctuations. This diversification can help smooth out overall portfolio performance and potentially reduce losses during market downturns. However, it's important to note that investing in bonds also comes with risks that investors should be aware of. One significant risk is interest rate risk. When interest rates rise, the value of existing bonds decreases, as newer bonds with higher interest rates become more attractive to investors. This can result in capital losses if you need to sell your bonds before maturity. Credit risk is another consideration when investing in bonds. This refers to the risk of default by the bond issuer, which could lead to a loss of principal. It's essential to evaluate the creditworthiness of the issuer before investing in their bonds, as lower-rated bonds typically offer higher yields but come with a higher risk of default. Lastly, inflation risk is a concern for bond investors. Inflation erodes the purchasing power of future interest and principal payments, potentially reducing the real return on investment. As such, it's crucial to consider the prevailing inflation rate and select bonds that offer a yield that outpaces inflation. In conclusion, investing in bonds can provide stability, diversification, and a reliable income stream for investors. However, it's essential to carefully assess the benefits and risks associated with bonds before making investment decisions. By understanding these factors, investors can make more informed choices and build a well-rounded investment portfolio. As I conclude, remember that investing is a journey, and it's never too late to start building wealth with stocks and bonds. Stay educated, stay patient, and stay disciplined. I hope this video has empowered you to take control of your financial future. If you enjoyed this video, give it a thumbs up, and don't forget to subscribe for more financial tips and insights. See you in the next video.